Welcome to The Explainer. Today, we're going to break down a really fascinating argument that's been making the rounds. It connects a pretty dramatic shock in the silver market all the way to the future of our entire financial system. Yeah, it's a big one.
Okay, so let's start with the number that's really at the heart of this whole story. $4.8 billion. Now, the rumor is this was the size of a massive margin call that just sent absolute shockwaves rippling through the silver market.
So to really understand why that number is so important, we have to look at what was going on right before it happened. The silver market was seeing some pretty unprecedented volatility, which really set the stage for this whole thing. Now, the analysis we're looking at immediately highlights this really stark contrast. You see, while Bitcoin's been pretty much trading sideways, silver has just gone on this explosive 150% run this year. I mean, just look at that difference.
And we're not talking about just a little jump here. This was a massive price spike. In fact, some analysts cited in our source called it absolute insanity. I mean, think about it. This move was so huge it briefly made silver more valuable than Nvidia, pushing it into the spot of the world's second most valuable asset. That's a big deal.
All right, so let's get to the main event. The rumor that, according to the source, might have been the trigger for this whole thing. This is where the narrative really starts to take shape.
And this quote from investor Larry Lepard really captures the gravity of the situation. He said, "Perhaps silver is the Lehman moment of the cycle." He's not seeing this as just another day of market noise. No, he's calling it a liquidation event, a sign that something, somewhere, just fundamentally broke. So here's the rumored timeline of how it all supposedly went down. It starts on a Friday with a ton of $75 call options getting exercised. Then the key date, December 27, 2025. That's when the alleged margin call failure happened. And in the days that followed, that's when we see the price just absolutely skyrocket.
So, digging into the details of this rumor, the core of it is that a systemically important bank, and the whispers say it was JPM Chase, failed its margin call. This whole incident is tied to a supposed $4.8 billion loss in silver futures, a huge number.
So you gotta ask, why does this one event in the silver market matter? Well, the argument we're looking at here is that this isn't an isolated thing. It's a symptom, the very first domino of a much larger problem in the system.
And this quote really sums up that perspective. Silver is the first domino because of how broken the system behind it really is. See, the idea here isn't about just one stock or one metal. It's about an entire system that's supposedly been stretched to its limit, just running on fumes.
So the argument really hinges on the very nature of our money, what we call fiat money, right? It's currency that isn't backed by a physical commodity like gold. Its value is based entirely on the public's faith in the government that issues it. And that brings up a huge question. What happens when that faith starts to wobble?
And according to this theory, here's how a systemic failure could play out. Step 1. You have a system with way too much leverage. It's overextended. Step 2. Some major event happens that causes confidence to just crack. And then step 3, capital flees. People start pulling their money out and rushing into scarce, tangible assets.
Okay, so this is where the analysis makes a really sharp turn. We've gone through the problem, this idea of a fragile system. Now we get to the core of the argument, the Bitcoin thesis. So the analysis basically says that while silver did a great job of exposing the problem, it's not the ultimate solution. The idea is that we need a superior asset, one that is provably scarce.
And this is where the source really draws a line in the sand. When it comes to scarcity, you can always mine more silver, right? But Bitcoin is capped at 21 million, period. Silver can be diluted with paper contracts, but that's not possible with Bitcoin. Silver's inventory is opaque. Bitcoin's ledger is decentralized and auditable by anyone. And finally, silver's price can be influenced, while Bitcoin's rules are enforced by pure code.
So according to this analysis, what you end up with is an asset that can't be diluted. It's something that can be easily audited and verified by anyone on the planet. It can move at the speed of light. The conclusion here is pretty stark, that Bitcoin is a better store of value by basically every single metric.
So where do all these roads lead? We've gone from a market shock to a critique of the whole system to a very specific thesis.
Well, the conclusion presented here is that as these cracks start to appear in fiat-based assets and over-leveraged systems, capital is naturally going to seek out harder, more transparent alternatives. It's a shift away from systems built on trust to systems built on proof.
And that leaves us with the final big question posed by this analysis. Is Bitcoin the silver bullet that's going to put an end to fiat currency forever? Or, to put it another way, Was that market shock just a random event, or was it the first tremor of a much larger earthquake to come?